We all want some level of safety and security. Firefighters, construction workers, EMT. They're all there when you need them to help manage life's chaos. In retirement, you want that same level of safety, but who is there for you to make sure your money will last? Brian isn't just there in case of emergency. He's there so you don't have an emergency with your money. A safer retirement doesn't mean a boring retirement, but a prepared one, full of the things that inspire you. This is Safer Retirement Radio with Brian J. Decker.
Welcome to Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. I'm Mark Elliott. Glad you're with us. You can always go to the website. I say this every week on the program. You can go to the website to learn more about Brian, Arrin, and the team. It's deckerretirementplanning.com, deckerretirementplanning.com. A lot of great information about the company, what they do, and, of course, the great team that Brian has assembled to help his clients retire to the best situation they can. So if you have questions, boy, can I retire? Do we have enough? Will our money last as long as we need it to? Will we be okay at the end of the day? You can always call the team. There's no cost, 833-707-3030. We'll give you that number throughout the program if you have questions about something that Brian and Arrin are talking about today. No cost for that whatsoever, 833-707-3030. But on the website, deckerretirementplanning.com, under the heading of Safer Retirement Education, there's about 12 different things you can download, including Brian's book, The Decker Approach. There's a lot of information there for you, 12 things you can just download. All of it, it's your choice. It's there for your information. Then maybe you get some of that and you might have more questions. You can call them, 833-707-3030. Brian, Arrin, welcome. And Brian, where are you going today? What's the topic?
We're going to talk about mid-year review process of your portfolio. Talk about income versus expenses. We're going to talk about portfolio performance reviews. We're going to cover it all. So, Arrin, let's start at the top here. In looking at a mid-year review process.
Yeah, so there's going to be a number of things that get built into this specific topic. I think it's going to continue or going to begin with, do you have the money invested how it should be invested, right? We've got 6 months in, trying to say, okay, what's the performance of my portfolio been? Hopefully you have some type of a diversified approach. Want to make sure that if there is any rebalancing needed there, hey, one category is outperformed or underperformed, or hey, I'm overweight or underweight in this specific category or sector. That's going to be a specific item that you're probably going to want to take a look at. The other thing for a mid-year review is going to be expenses, right? Hey, how have we done following the budget that we have this year? Or do we even have a budget? Do we have a clear picture of what our spending should be or needs to be? Or are we just kind of winging it and hoping for the best? I also think that nailing down, if you're still working, some of those contributions is really important, right? You're almost halfway through the year. How have you done with 401k contributions? Have you done anything into traditional IRA or Roth IRAs? Are you adding money into an HSA? Do you have a savings goal, high yield savings account, money market that you're trying to set aside for emergencies? It's really nice to be able to just have that check-in point where you can say, okay, here's what we wanted to get done. Have we actually done that so far? If not, what kind of tweaks do we need to make? Here's the specific categories that we need to take a look at. So again, investments, how have our expenses been? Are we saving according to where we need to save, getting it into the right tax types, into the right accounts, making sure that what we're doing now is going to have us happy in another 6 months, another year down the road from now. Anything you'd add to those categories, Brian, before we move into those specifically?
No, good list of categories, but I'm anxious to drill down into the details.
Yeah, so let's talk a little bit about the income and expenses first. So where we here at Decker Retirement Planning do focus on people that are either already crossed that threshold into retirement or within just a couple years of that point, one of the major things that we discuss with clients is making sure that their income is sufficient, but it's also going to last them for as long as they need it to. Nobody wants to run out of money before the point in time that you pass away. So making sure that how and when you're spending your income not only takes care of the expenses that you have, but also lines up with the assets and the overall financial situation that you have. Now, what we've found with a lot of clients that have come into our office is that there's a lot of different ways that people approach this, right? You work all of your life, you accumulate these assets, you have a big 401k or savings account or other retirement vehicles, and now you're trying to figure out how do we actually make the rules or what kind of a discretionary system do we follow to actually withdraw money out of the portfolio? Is it just on an as needed basis? Is it a percentage every year? Is it a set dollar amount every year? Is it based off of portfolio performance? So there's a lot of different ideas that people throw out on how to approach the income and expenses. But at the end of the day, you really want to have a clear picture of, number one, what is actually sustainable for you, right? Nobody wants to start their spending out at $15,000 or $20,000 a month and realize 5 years into retirement, we actually got to cut that in half. We didn't have as much money as we thought we did. On the opposite side, we also have a lot of people that come in and they're already retired. They've been that way for a few years. They're in a pretty normal spending pattern, and they've been underspending relative to what they could, right? They say, hey, we're spending $8,000 or $10,000 a month. We build them a plan and say, look, you can actually have 15. And they're like, oh my goodness, this is wonderful. We would love to go spend more on travel or our grandkids or help out people in our community. So the big thing here really is just the knowledge of what is actually possible for you, right? Having that math behind the financial plan to show you what is actually doable from an income perspective. So that's going to be one of the main things that we do here at Decker Retirement Planning is take all of those assets that you've worked so hard to accumulate, build those into a specific plan structure, take into consideration all of those other variables, your age, if one of you is still working, your other income sources, Social Security, rental income, all of those things to give you a clear picture of what your sustainable level of income actually looks like. So what I found is that it really just helps from a decision-making standpoint, right? If you know what level of income you can sustain, you know where it's coming from, you know that it's going to be protected, it really helps to give a lot of peace of mind, really helps to be able to base decisions off that information, right? If you know in 5 or 10 years your income is going to be X, you can plan for that now if you need to move or if you want to support kids or grandkids or if there's other things that you want to do. It's just helpful in a future decision-making process. So, Brian, anything you'd add to that before we continue?
No, that's good. I'm waiting for the specifics on how we do it compared to the other firms out there in measuring mid-year where they stand kind of performance.
Yeah, so there's going to be a couple different pieces to this. So for our clients, let me first talk about the distribution method, and then I'll talk about current clients and our review process for them. So with people that come on board with us, we want to make sure, again, that we're setting up a proper distribution plan, that not only are the assets invested how they need to be invested, but we've also got the income set up to both allow you to withdraw a maximal amount without putting you at risk of running out before the point in time that you pass away. So I want to be clear first off that this is not something where we use a set percentage withdrawal rule. So a lot of times you'll go online and you'll hear about, hey, I'm going to take the 4% withdrawal approach or the 3% withdrawal approach. Those leave a lot to be desired when looking at covering all your bases. Meaning, if you take a 4% withdrawal approach and you go through a flat market cycle like January of 2000 to 2013, you are not going to be very happy at the end of that time period because you're actively withdrawing 4% of your portfolio per year. Market has performed terribly. You've really made no growth over the course of a 13-year period, and you've been actively withdrawing income. Not a great combination when you have a lot of those assets at risk in the market. So for us, we want to make sure that not only is the money invested between your emergency cash, principal guaranteed account or safe money, and your risk bucket, that's going to be step number one, is allocating that appropriately, but also making sure that all of your other income sources are built into the plan. Meaning if you have Social Security or rental income or a pension, or maybe one of you is working part-time, one of the big mistakes that we see people make is that they look at a lot of these decisions in silo, right? They say, hey, I'm going to look at Social Security and decide on that. Then I'm going to decide when I'm going to take my pension. Then I'm going to decide how much money I'm going to pull out of my 401k account. They don't look at them in conjunction with one another, merging all of those different things together. And that leads to some pretty nasty outcomes, or at least some suboptimal outcomes, right? Where you didn't do things that were going to maximize the value of those assets. So first off is just making sure that you have the right structure in place. You've got the right categories of investments. You've got the right plan. You know how much you're supposed to be withdrawing out of those accounts every year. And that's exactly what our income distribution plans do here at Decker Retirement Planning. Now, once we have those in place for you, once you're a current client, we've got that plan running, you're actively withdrawing income out of those assets that we put into place for you, then we want to make sure that that plan is continually working according to your goals. So the first thing that we want to talk about is, have the goals changed? So when we initially went through the visits, talked about how you want to use your money, what the purpose of those assets are, what's going to provide meaning and value to your life, we want to make sure that that's still the case. Now, there's a lot of life events that are going to happen over time, right? A spouse passing away, you decide to move, you downsize your house, one of you decides you wants to go back to work, something changes with your family or your children. So there's a lot of other things life-wise that can pop up that are going to adjust or alter your goal or your priority for that money. So we'll talk a little bit about, number one, are those goals still the same? If so, how is the income working for you so far? Has it been sufficient? Is it too high, too low? Are there other tweaks or adjustments that need to be made as far as a monthly withdrawal standpoint? And then also in conjunction with that, we can talk a little bit about any investment allocations that need to change, right? Is there an overweight or underweight? Have we massively outperformed in one category, so we need to take some of that asset base and redistribute it among others? Recently, with the market being in a tear and our actively managed portfolio doing really, really well, we've done that for a number of clients where they've had massive outperformance in their market-based strategies. So they want to take some of that off the table, lock in some of that growth, diversify some of those assets. And so there's a lot of different things that we want to make sure that we get right at the beginning when we put those plans into place, and then make sure that we're doing those ongoing reviews to make sure that it's still aligned with your goals. All of those assets, income streams, investment allocations are all working in cohesion to make sure that you're happy at the end of the day, lining up those goals with the action steps that we're taking there. I think the next thing I want to tie to those checks is, again, just making sure, especially for those of you that are still contributing, whether you're working or you just have some excess income that you're trying to get into more tax-advantaged accounts, we want to make sure that that's being done properly, right? So there's a lot of different ways to handle tax planning. And we want to make sure that not only are the contributions, like the new money that you're putting into 401ks, IRAs, Roths, HSA accounts, that you're doing that properly, but for any money that you have currently, making sure that Roth conversions are also being taken into consideration. So those are going to be something that we look at both pre and post-retirement. Every client situation is going to be a little bit different. Sometimes it makes more sense to do conversions before retiring or after, or maybe a combination of both. And so again, as you're doing those mid-year check-ins, you want to make sure, are all of the contributions going to where they need to be going? Are there any adjustments that we need to make to be able to hit the specific amount? Maybe we're going to be over. Hey, I've contributed, or I've made more money than I thought. I need to dial back my 401k level. Just kind of double checking on those, making sure that they're set up properly. And that would be the one last thing that I'll touch on here, is that just checking in on this is super important, because I can't tell you how many people I've had come into my office that I ask them, hey, how much are you contributing to your 401k? Or what is that money invested in? And they're like, I don't really know. I put it into place 5 years ago or 10 years ago when I got hired, and I really haven't looked at it since. So again, please just double check those things, make sure that they're still aligned with your goals, that you've got those little steps in place that are going to get you where you want to be in 1, 5, 10 years down the road.
So if you'd like to follow up on this, figure out where you are, and are you on the right track? Are you doing the right things? Do you need a tweak here or there? Brian and Arrin and the team at Decker Retirement can certainly walk you through your situation. Now you have a better understanding. You got some clarity into your situation. All you have to do is call them. There's no cost for this whatsoever. 833-707-3030. I still think it's one of the more important phone calls you could make, because we are talking about the next 20, 30 plus years of your life. Having a plan, heading into retirement. The plan obviously has to change with things that happen to you in your life, because it's a flexible plan. But at the end of the day, it is about you. Income, investment, taxes, healthcare, legacy planning, all of that. 833-707-3030. A great opportunity for you. Take advantage. Why not? It's just a phone call. I have a conversation. 833-707-3030. Glad you're with us today for Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement. We're just getting started. We got a lot more to get to. Back with more right after this.
Filing for your Social Security benefits is like trying on a pair of pants. You can't just assume one size fits all. Visit with Brian Decker and the team at Decker Retirement Planning to explore your options. Call 833-707-3030. Like your pants, it's important to find the right fit. That's 833-707-3030.
Remember that first paycheck when you started working all those years ago? You looked at the net amount and thought, whoa, what happened here? Ah, the joy of taxes. It could be this way with your retirement accounts. You know how much you've saved, but if you haven't planned for Uncle Sam, you could come up short in retirement. With tax laws constantly changing, there's a lot you need to know to make sure you're not paying more than your fair share. Financial advisor Brian Decker and the Decker Retirement Planning Team can help you create a plan that shows you how taxes could affect you now and in the future. Set up your tax strategy session with Brian and the team at Decker Retirement Planning now. Call 833-707-3030. That's 833-707-3030. Make sure you know how these changes could affect you so you can avoid some of those whoa moments in retirement. Call 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk, including the potential loss of principal.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. Again, the website, DeckerRetirementPlanning.com. Questions? Just call them. 833-707-3030, 833-707-3030. I'm Mark Elliott. Brian and Arrin talking about really mid-year. Where are you? Are you on the right track? Are you ahead of where you wanted to be? Are you behind where you wanted to be? Are you not even sure where you are as we get to this halfway point of 2026? Brian, you wanted to talk about portfolio performance review that the team at Decker Retirement does it maybe a little differently than some other financial groups.
Yeah, I came from a portfolio management background where if you want to do quarterly rebalancing, make sure you've got all those boxes checked as far as making sure you're diversified among large cap, mid cap, small cap, growth, value, emerging markets, international, bonds, and some cash and gold and alts. Anyhow, just making sure that all those quadrants stay about the same. So I'm going to be a little sarcastic here. So technology and semiconductors specifically in the first 6 months of the year have gone parabolic. And you definitely want to sell those. You don't want those to continue. I'm being sarcastic, remember, because those have created imbalances in your portfolio. You want to add to things that are going down like gold, silver, and basically everything else. Tech and AI and semiconductors, anything related to those three things have essentially carried the day since spring of 2023. So the last 3 years, if you haven't been in tech, semiconductors, or AI class type investments, then you've left a lot of performance on the table. Now, we don't do it that way. There's a big difference between accumulation and money management. So accumulation is what happens in your 20s, 30s, 40s, and 50s in preparation for your retirement. You can afford to take bigger risks, have more stock exposure during those years, because if your portfolio goes down by 50%, no big deal, because your income is coming from work. And you're, in fact, every 2 weeks, you're adding to your portfolio in your 401k while it's down, and you have the time, you have the 3 to 5 years for the markets to come back. Let's switch it. Your 65 portfolio is how you're managing it, not your 401k. You're not adding to it every couple of weeks. In fact, that's producing income that's supposed to last you for life, along with Social Security, maybe possibly some rental income, maybe possibly you're lucky, fortunate enough to have a pension, but that has to last the rest of your life. So now if markets go down 40 or 50%, that is a game changer. So we at Decker, we do things quite different. We manage risk quite differently. And I'm getting to this portfolio rebalancing that we think is nonsense, and I'll tell you why in a second. First, when it comes to portfolio management, One way that we significantly reduce client risk in retirement is we pull back stock exposure from a 60-40 or 70-30 portfolio to where we don't have 60 or 70% of all you've earned in your adult life in the stock market. We think that's insane. We put about 25 to 30% of your portfolio in the market, and that's your long-term money. And that's going to be your inflation protected. We'll talk about how that's managed in a second. So the first way we lower risk is quantitatively. We don't have 60 or 70% of your portfolio at risk. We have about 25 or 30%. Second is we don't have any interest rate risk. When interest rates go up, your bond funds lose money. Now, bond funds is what bankers and brokers use for your safe money. Well, guess what? When interest rates go up, you lose money in bond funds. Interest rates have been going up for the last 6 years. Even with the Fed lowering rates, bond rates have continued to trend higher. So your quote unquote safe money for the last 5.5 years have lost on average of over 30%. That is a hit. So we have erased and zeroed out interest rate risk because we don't recommend client exposure to bond funds in interest rate rising periods like right now. The third way, and this is significantly important to what we're talking about right now, which is reallocating your portfolio. The third way we lower client risk in retirement is strategically. We're fiduciaries to our clients. We're an independent company. We're math-based, and we take all that very seriously. So we've done our homework, and we've gone back to find out what produces the highest returns in the stock market. And the biggest study ever done of over 50 years of data was done, and it said there's strategies called relative strength, sector rotation, and momentum. Those are the big three. In fact, ladies and gentlemen, those three are one. So imagine all the stocks, indexes, and ETFs are ranked. So it is sector rotation, it's relative strength, and it's pure momentum. That's how we invest for our clients. So since 2023, our clients have been very heavily weighted in technology and semiconductor and AI, and also utilities for a time, because the data centers drain and demand on energy from our utilities companies that used to be stodgy 4 or 5% dividend producers and no price appreciation at all. Well, now they're going up 20%. So we own those. We own what is going up. In 2022, if you own tech when Russia invaded Ukraine, you lost 30% that year. So that was a year that we rotated out of tech. We have stop losses, and momentum had us in energy. Anything energy related that year was up. The natural gas, crude oil companies and the pipelines made 15 to 20% in 2022 when the S&P was down 19, NASDAQ down 33, bonds down 20, commodities across the board were down except for energy. So strategically, we very carefully for our retired clients own what is going higher. But here's the other point, and that is in the last 100 years, every time market valuations got up over 30 times trailing earnings, and that's only happened 4 times. 1929 was the first time. Markets were flat for 17 years. 1964 was the second time. Markets were flat for 18 years. 1999, November of 99, markets were flat for 14 years. Well, in October of 2021, we hit 32 times trailing earnings. And if history repeats, we're 2 steps forward, 2 steps back for the next 10 to 15 years. To make zero money in 15 years in retirement is devastating. So we've taken steps strategically to lower our risk because there's 2 ways to make money in a flat market cycle. One is dividends. They pay dividends whether markets are up or down. And the second is momentum, buying whatever is going higher. So in 2008, Treasury bonds were up 20% when the S&P and everything else had a waterfall decline that year. In 2000, '01, and '02, when the S&P was down 50% and the NASDAQ down 70%, there were many sectors of the markets that went higher. Real estate, gold, silver, energy, pharmaceuticals, biotech, and healthcare. All those made double-digit returns each year for 3 years until the markets bottomed in March of 2003, and then you rotated right into technology, semiconductors, small caps, and emerging markets. So this is a way that we lower our client risk. Now, all the way back, Arrin, to do we rebalance our portfolio at mid-year? The answer is no. Because of our momentum strategies, our clients are enjoying this run until it runs out. As markets go higher, price targets are met, cash values increase. So right now, our cash values have us at 30%. We're waiting for the markets to pull back. And we have money to rotate back into whatever is next that's going to have the highest relative strength numbers. So that's how we invest. The trailing, now 80% of money managers and mutual funds underperform the markets every year. That is why a lot of people own the S&P. They'll buy the index, but strike 1, 2, and 3 is passive investment management. There's 2 reasons why we don't recommend it. No downside protection, and 2, passive buy and hold investment strategies with market valuations this high are the very source of flat market cycle returns of 0 over the next 10 to 15 years. And that's what we want to avoid clients at Decker.
So again, if you'd like to talk with the team at Decker Retirement, it's a great opportunity to kind of see where are you. Do you have 25 or 30% of your money protected and the rest is there to grow for down the line? Or do you still have basically all of your money sitting in IRAs and 401ks and it's at risk, all of it? There's a transition that has to be made at some point, and the team at Decker Retirement can certainly walk you through your situation. Some people need 80% of risk. Some people need 20% of risk. Everybody's situation is unique, and that's how the team will look at it. Where are you? Do you know where you are? 833-707-3030 again is the number. No cost to you, no obligation, no pressure. The team's here to help if they can. Will you become a client of Decker Retirement? Maybe, maybe not. It's got to be a good fit for you. It's got to be a good fit for them. 833-707-3030 again is the number. No cost whatsoever. Why not take advantage? 833-707-3030. Brian and Arrin back with more Safer Retirement Radio right after this.
Your story is unique, and so is the legacy you leave behind. Connect with Brian Decker at 833-707-3030 to start writing the chapters of your legacy and ensure it reflects your values and dreams.
Glad you're with us today for Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. I'm Mark Elliott. Glad you're with us. Again, questions, anything they're talking about, you'd like to learn more, how does this really affect you and your situation? 833-707-3030, 833-707-3030. All right, Arrin, where are you going to pick up from what Brian talked about in the last segment?
Yeah. So Brian did a phenomenal job talking through the way that we think about risk, how your portfolio should be structured in retirement, making sure that you have the right types of investments in place. And what I want to share here that kind of adds to that is how that's actually going to show you the income that you can take in retirement. So to kind of set the stage for this, everybody has this golden picture of retirement, right? When you start working, you're like, hey, look, here's what I want to do. I want to make this amount of money. I want to save. I want to get my 401k to X amount. Here's what I'm hoping for income-wise in retirement. And it just seems so far off into the distance, right? Retirement just is like, yeah, I'll get there someday. It'll happen eventually. It's just kind of this thought at the back of your mind, right? But eventually, that point in time actually comes, right? And I have people sit across from me all the time say, man, I can't believe I'm actually retiring, or I retired 2 weeks ago. This is so surreal to actually shift into that. So one of the things that we want to make sure of is we know that retiring can be a pretty exciting thing, but we also know that it can be a very anxiety inducing thing, right? Have you done what you have needed to do to carry yourself through retirement? And one of the main ways that we're able to put our clients' minds at ease is by showing them mathematically how all of that hard work that they've put into building up that asset base is now going to translate into what that money can actually do for you in retirement. Because you didn't build up that massive asset base just to have it, right? It wasn't just for the sake of seeing the number go up. You had a plan for what you wanted to do with that money in retirement. Now, a lot of times that's going to involve income, right? You have assets that you need to live off. You're going to need to withdraw some. Now, that may not necessarily be the case as well, right? There's exceptions where people have really large Social Securities and pensions, rental income, and other things, and they just have a legacy goal for the money. But at the end of the day, you want to make sure that all of that hard work that you put in is actually put to good use when you shift into retirement. So, as an example, for somebody that wants to use that money as an income stream in retirement, you have to figure out the best way to do that, right? Now, most of the time, people are looking to both maximally spend, meaning enjoy that money on an ongoing basis, but also not put themselves at jeopardy of running out before the point in time that they pass away. Now, when you go have a sit-down visit with a traditional advisor, somebody that's a little bit more focused on that accumulation or that wealth building phase of your financial life, most of the time, what they're going to show you from a quote-unquote retirement plan standpoint is a pie chart and what's called a Monte Carlo simulation. This is saying, hey, you've got $1 million in your retirement assets based off of your age and withdrawing 4% per year and some projected rate of return based off market returns. Here's what we're expecting that you can withdraw every month or every year as income. Now, this leaves a lot to be desired when looking at a secure or a safe holistic retirement plan, because again, this assumes that you have the majority of your assets at risk in the market, could be 60, 70, 80%, and the minority is typically going to be protected. And again, that leaves you open to a lot of uncertainty in the future, right? It could work out in your favor if we have another 10 or 15 years that's an upward trajectory. Brian just talked about all of the reasons why that's very likely not going to be the case, right? The high returns that we've had the last 10, 15 years after the 08-09 crash, the valuations that we have, some of the stock market fundamentals are getting a little rocky at this point in time. So I would not bet my house on the fact that we're going to have another 10 years of prosperity there. But you also have to make sure that you have enough growth in the portfolio to sustain your retirement years, right? Most of the time, people retire at 55, 60, 65. You're going to have a long time in retirement, 20, 30, maybe even 40 years if you have a nice long life. So it's really making sure that you balance both of those as far as making sure that the money is going to last as long as you need it to, but also making sure that you're not going to underspend relative to the assets that you have, right? You worked for this, you saved this money, you want to make sure to actually enjoy it. So this is really where our income distribution plans come into play. Now, these are mathematically based to show you where we would recommend your money be invested. And then we also take that into consideration in conjunction with your outside income sources to show you how all of your money is going to be used to supply regular monthly income, show you what you actually get to take home and spend every month. So the way that we do this is we start by first allocating the money to those three categories of investments. Category one, emergency cash. We want to make sure you have a small cash account set aside for unexpected expenses. Second, and this is going to be the majority of the portfolio typically, are what we call principal guaranteed accounts. These are protected from market loss. They are what we use to withdraw income out of every month to be able to supply that safe, consistent income stream for you. And then the third category, the risk bucket, Brian just talked about in our last segment. This is where market exposure is still appropriate. This is money invested for a longer time horizon. You're not actively withdrawing from this for income. It'll be assets that are used later in retirement to help supply a portion of that income for you. So first off, we want to make sure that those assets are invested accordingly. And then we want to take into consideration all of your outside income sources, your Social Security, pensions, rental income, if you're still working or one of you is working part-time, anything else that's going to supply you with taxable income. So we want to make sure that all of those things are accounted for. And then we help you calculate what level of income you can pull out of your retirement accounts every month, every year, running those plans out to age 100. Now, one of the really neat things about this is it takes into consideration when your other income streams are also part of the plan. Meaning, I actually had a meeting earlier today with a client that has a pension, but it doesn't start until the point in time that he's 65 and he's right now 57. So he's got an 8-year gap between when he's retiring and wanting to take income and when that pension starts 8 years down the road. So we help to pull a little bit more out in this 8-year gap to supply that level of income. Then when his pension kicks in, has that extra income stream coming in, we reduce the amount being withdrawn from the retirement assets to help offset that. Can be the same concept if you haven't started Social Security yet, or maybe you sold a business and you have a 5-year or a 10-year payout and then it drops off after that. So the concept here is that you want to take all of those pieces of your financial situation into consideration when building a holistic plan, so that you're not looking at one on an island and you realize 5 years down the road, oh, this actually didn't work out very well. I should have done X, Y, and Z, or I should have looked at this. That's what we do here at Decker, is making sure that we're looking at the whole picture, getting all of those details outlined, and then drilling down into all of the specifics to make sure that that gets implemented and invested properly for you. So with that, again, we've got those assets in the principal guaranteed accounts and the risk bucket that we've invested for you that help supply an income stream. And then we help take into consideration all of your outside income sources. Adding those all together will get you to your gross income. And then we want to account for taxes, right? If you're in a state that has state income taxes, everybody's going to have federal taxes. We want to make sure that those are accounted for. And then that drills down to show you exactly what your net monthly income, or what you get to take home and spend every month, is. Now, again, I mentioned earlier that we want to hit that sweet spot, right, of making sure that you are both able to maximally spend, but also make sure that that money is going to run at least until your age 100, making sure that if you have a nice long life, funds are there and you're taken care of and provided for. So this will show you exactly the income level that you can sustain. And what happens most of the time is we build this plan out and people are like, wow, this is a lot more income than I expected it to be. This is great. I have a lot more freedom to do X, Y, and Z thing. Or, hey, we've always thought about taking a trip or buying this car or getting a vacation house or doing whatever they want to do with that money. And this shows them that they have the freedom and the flexibility to be able to do that. Now, on the opposite side, we also have a lot of people that come in that are not yet retired. They have a specific income goal that they're trying to hit in retirement, and they're figuring out the roadmap to be able to get there. And that's one of the other things that these plans can do for you, is show you what action items or what action steps you need to take today to hit the specific goals that you have in the future. So if we say, hey, your target income is, I don't know, $10,000 net per month, here's how long you're going to have to work to be able to hit that. Or, hey, here's how much in savings you'll need to be able to do. Or, hey, maybe you could do this move. You're selling a business, you're selling a rental, you're making some kind of an adjustment at work. All of those things, we can kind of do a brainstorming session with you and then show you mathematically what the results of those different decisions would be. So it's a great way to be able to just get a clear picture of what that retirement roadmap, both pre and post retirement, is going to look like. These plans, we typically approach from an iterative process, meaning the first version that we show you is not going to be the final one. We are supportive of our clients throughout their entire retirement years. And so we want to do a lot of due diligence before we actually put anything into place, to make sure that not only do we have the right structure, right, the right investments, the right timing for this, when you're going to draw Social Security, but also that the long-term plan that we've got in place is going to meet the goals that you have, right? Is it maximum spending? Is it, hey, I want to build up as much of an inheritance as possible to pass to my kids or grandkids or other beneficiaries? Is it a combination of those? Is it you have specific amounts that you want to give to charity while you're still alive? So there's a lot of different goals or priorities that our clients have for their money. And so our job, our role here at Decker Retirement Planning, is to help you uncover what those specific goals are, what's important to you, and then figure out the specific action steps that we need to take to be able to get you there.
So again, if you have questions, you'd like to learn more, how does all of this really make sense to you probably would make more sense if you actually went through the process with Arrin and the team at Decker Retirement to actually figure out where you are on that road to retirement, right? Do you have enough? Do you not have enough? That's a pretty simple question, but it's not an easy answer sometimes. People that have $1 million or $2 million, sometimes it's not enough. Somebody has $250,000's plenty. Depends on your lifestyle and how you spend money. And if you have a handle on all of that, debt and all those kind of things that go into having that retirement you've always dreamed of, you need a plan, you need a strategy. The opportunity is here to talk with a team that really specializes in the retirement planning world, like Brian's team at Decker Retirement Planning. So again, if you would like to talk with them, you got questions, you want to learn more, you want to really kind of fill in some of those blanks. I think we're okay. I hope we're okay. I wonder if we're okay. It's 833-707-3030, 833-707-3030. Great opportunity to find out where you are on that road to retirement. Right now, call the team at Decker Retirement, 833-707-3030. Back with our final segment with Arrin and Brian. Right after this, stay with us. This is Safer Retirement Radio.
War involving Iran is driving uncertainty in the markets. The question is whether your retirement timeline can withstand it. Call 833-707-3030 to schedule a retirement review with Decker Retirement Planning. Call 833-707-3030.
Not only is it annoying, but that leaky faucet can cost you a lot of money. Do your retirement accounts also go drip, drip, drip? Even small fees can add up. Combine that with taxes, and all of a sudden, you could have a pool in your basement. Financial advisor Brian Decker and his team at Decker Retirement Planning can't help you with that broken faucet, but they can help you fix those leaky accounts so you're not paying more in taxes and fees than you have to. Decker Retirement Planning loves helping families just like yours reduce taxes and fees as part of their customized retirement planning process. Call now to see if they can help you too. To set up your visit with Brian and the Decker Retirement Planning team, call 833-707-3030. Don't let any more of your hard-earned dollars go down the drain. 833-707-3030. That's 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk, including the potential loss of principal.
If you only think about taxes once a year, you're doing it wrong. To get the most out of your retirement nest egg, you shouldn't just file your taxes. You need to plan for them. Call Brian now to see what tax opportunities you could take advantage of. 833-707-3030. That's 833-707-3030.
Welcome back to Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. I'm Mark Ellie. Glad you've been with us. As I started the program, I want to go back and remind you, you can always go to the website to find out more about Brian, Arrin, and the team, obviously, at deckerretirementplanning.com. But you can also go there because there's like 12 different things you can download. There's books, useful guides. There's Brian's book, the Decker Approach book to retirement, the 3 Principles of Retirement book, checklist, challenge, sample income plan. That's just 4 of the 12 things that are there. You can download any or all. There's no cost to do so. There's no obligations there for your information. We've been telling you, if you have questions about anything that they've been talking about today, you want to learn more, how does that really affect you and your situation? 833-707-3030, 833-707-3030. And Brian, with all this talk of mid-year assessments, hey, where are we? Are we on track? Are we doing the right things? What do we do in the second half of 2026? I thought it'd be a good time for you to maybe explain to people, because I hear it all the time. Man, the stock market's really been good. It's been much better than we thought. Job, records aren't doing great. The economy, boy, I'm paying too much in gas and groceries. There's a disconnect between the market and our economy. Is that fair to say?
That is fair to say. So food prices have been going higher. Gas prices have been going higher. The necessities or the essentials have squeezed middle America. Half the country, I'm looking right now at ChatGPT, 40 to 50% of Americans say they're living paycheck to paycheck, depending on the survey. 78% of workers said they would experience at least some financial difficulty if their paychecks were delayed by 1 week. So that's a big chunk of the country that is really getting hit by the higher gas prices and getting squeezed pretty hard. The other half of the country own a home and are experiencing that appreciation. They have money in the stock market that is at or near all-time record highs, and they're experiencing affluence. So half the country is happy and half the country is really getting squeezed. It's interesting also in the jobs numbers. How can we have layoffs like we've had and the unemployment not move much at all. That's a couple of things. First, we've had people that are leaving the workforce. These are people that are illegal aliens. They've had 2 million of those deported or self-deported over the last year, according to some of the numbers from the government. And yet we've seen a lot more people. We haven't seen the unemployment number move, but we've had the jobs numbers be weak. So we've had also fewer young people because of our demographic. Our birth rate, our replacement rate is much lower. And so we have fewer people looking for jobs because of the demographics. So those are two things that are feeding into the jobs numbers in the first, probably 3 months ago that were pretty weak, but the unemployment number not moving. But as far as making sure in retirement that we are doing the right thing here in mid-year, Arrin, what else would you add here as we get near the end of the show?
Yeah, the other thing that I want to talk a little bit about here is, again, just the difference mindset wise between your accumulation or working years and your retirement or distribution years. It's really common for us to have people come in and they've built really good habits over the course of the last 30 or 40 years where they're working, they're saving, they're preparing for that retirement phase. And then as they get into retirement, it's really hard to change some of those habits, change some of those mindsets to make them more effective for the phase of life that you're in, that distribution or retirement phase. So here's a couple of the common ones that I run into and some of the typical feedback that we give people. So the first one is going to be how to handle your emergency cash. So a lot of times you'll hear in the financial industry, hey, you need to have 6 months or 12 months worth of expenses. That's the emergency cash value that you need to build up. Now, in retirement, the view around emergency cash is going to be a little different. Now, a lot of times people say a 6 or 12 month emergency cash because they're worried about getting laid off or fired, and they're going to need some type of place, some account to pull income from when they don't have wages coming in from a job anymore. But if you think about it, in retirement, when you're not working anymore, you don't have anybody that can fire or lay you off. You're actually drawing income from your portfolio versus out of the wages that you're bringing in every couple weeks. You don't need the same viewpoint on emergency cash of 6 months or 12 months of expenses because you fully control the accounts and when and how much you're pulling out of those specific accounts. So for emergency cash for our clients, it's more about some of those expected/unexpected things that can pop up, right? Your car needs a repair. You have a home improvement thing. You need a new roof. The water heater goes out. Those types of things that can pop up. Now, sometimes you might have a pretty good idea about what that looks like, right? You know, hey, I've had a tech over. I know that I'm going to have to replace my roof here in the next 6 months. Or, hey, I know I'm going to have to do this specific upgrade. But outside of that, it's really just making sure that you have a small cash account set aside for those random expenses that you don't want to pay for out of your monthly distributions. Again, a lot of times this is cars or home repairs, or maybe if you have rentals, you're like, hey, I got to set a reserve account aside for upgrades when a tenant moves out, things of that nature. So again, the emergency cash is going to be one, just shifting from a set number of months of expenses to, hey, this reserve account is for specific repairs or specific types of things that may pop up from a lump sum standpoint. The second one, and this one's going to be a little bit bigger, is actually adjusting how you're spending money. And what I mean by this is typically as you're working, you have your normal expenses, right? You've got your housing expenses, food, gas, healthcare, some of those other things that are just normal expenses, everyday things that you need to pay for. And those are still going to be there in retirement, but you're typically paying for those during your accumulation years out of your wages. Now, when you get to retirement, and we here at Decker build you out a plan that shows you how much income you can spend, what I found a lot of times is people have a difficult time adjusting their mindset from that accumulation mentality of, hey, I need to continue to save. I need to make sure that my 401k or my retirement asset balance is going up every year, to, hey, now it's time to actually switch gears, turn the spending spigot on a little bit, and actually start utilizing that money. Some of these accounts are going to go down a little bit because you're spending them. You're not actually saving on a monthly or biweekly basis. There's just some of those action items and mindsets that need to be adjusted to more effectively use those assets in retirement, right? If your goal was to accumulate those assets in order to retire and make sure that you're able to pull that on a regular basis for income, when it comes time to do that, that's what we're going to help you do, right? We're going to build that plan out. We're going to show you exactly how much income you can have. And we want to make sure that you're using that in a way that's going to be meaningful to your life, right? Is it meaningful for you to go travel or pay for grandkids' activities or hobbies or take your family on trips? Or do you want to build up a large legacy value to give as an inheritance amount when you pass away? Right. So that's why it's so important for us not only to go through that goal setting exercise at the beginning, really nail down what it is you want that money to do for you. But from a behavioral coaching standpoint, we're also going to be there walking right alongside you, making sure that you're actually doing those things that are going to use that money effectively and bring value to your life. Because I do have a lot of clients that we build out a plan. They're like, oh my goodness, I am never going to be able to spend this much money. I don't know what I would do with all of this. And we have to kind of think of things that are going to help them, again, use that money in a manner that's going to actually bring value or meaning to their life and help them feel okay doing that, right? Help them feel okay that it's time to start spending, that it's the time to actually start maybe giving money to charity or helping your kids with home down payments or education expenses, and that you're going to be okay based off of the mathematical structure that we've built, showing you what your assets can do for you both income-wise and growth-wise throughout retirement. So I sometimes have people jokingly tell me, hey, I've always thought about buying this car, or I had a lady in my office a couple weeks ago that is really into photography, and she had been eyeing this, I think it was like $15,000 or $20,000 like extensive camera setup. And she was kind of jokingly saying to her husband, hey, I'm going to go buy this. And I'm like, in all reality, you have the money to be able to do that. If that's going to bring you happiness in your life, if you're going to use that, if this is going to be something that'll help you enjoy your hobbies, why not, right? It's not like this is going to impact the amount that you have to spend on groceries every month. If you have the money and you have a use case that you want to spend that on, we want to help you be able to do that. So again, from a behavioral standpoint, this is also one of the really important things that we help people with here at Decker Retirement Planning. Obviously, we want to make sure that the math works out, that your funds are invested the way that they need to be, that you have the income for those regular expenses. But we also want to make sure that you are getting good use out of those assets. Again, making sure that you're using them in a way that's going to bring meaning and value to your life. So if I have a client in that situation and they come to me and say, hey, I'm going to go buy this boat, or we've thought about getting a second house somewhere, or we've thought about buying this classic car, or doing any of those types of things, I'm going to encourage you to do that. Now, again, we want to make sure that the math works, right? That it's taken care of from an income standpoint. But once that is taken care of, we want to make sure that you really get to enjoy those assets. I'll explain to you that you're going to be okay, help you have that peace of mind, really make sure that you've got those numbers in front of you to give you that solidified or the way to make those solid decisions based off of the math there. But again, making sure that you get to use and enjoy those assets really brings a lot of value, not only to the work that we do here, but also all of the hard work that you put in over years and decades of building that up. You actually get to see the fruits of your labor there.
Brian, anything you would add before we wrap up today's show?
Yeah, a lot of clients come to us to find out if they can retire. We run the numbers for them to see if they can retire, and we'd be happy to do that. So if people are thinking that they maybe can or can't retire, we can in the office and run the numbers and find out if that income that can be generated from their portfolio is enough for them to retire or not. Those are fun meetings.
I think it's one of the great opportunities that Brian and the team at Decker Retirement give you every week on this program is a chance to have a sit-down chat with them. You can talk first on the phone, just have a conversation, and then, hey, does it make sense to go a little further and maybe delve a little deeper into your situation? But that's really what the phone call is about. Here's my questions and my concerns. What do you think? 833-707-3030. Because at the end of the day, you have enough or you don't have enough. And if you don't have enough, how do you figure out how to still retire maybe with not quite enough, but you have more strategies involved? Or maybe you've got plenty, but you don't even realize it. It's such a great opportunity, I think, to find out more about where you are on that road to retirement. 833-707-3030, again, is the number to talk with the team at Decker Retirement. No cost to you whatsoever. 833-707-3030. 833-707-3030. Might be the most important phone call you make, certainly today. All right, Brian, Arrin, always enjoy the time. Enjoy the rest of the weekend.
Thanks, Mark.
Thanks, Mark.
Security and insurance services offered by Decker Retirement Planning, a registered investment advisor with the SEC. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Decker Retirement Planning is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Decker Retirement Planning. This radio show is a paid placement.